Hello and welcome to NIFA's Webinar Wednesdays, a weekly virtual series specifically designed for Nebraska communities and housing partners. Today we will be having an economic update. I'm Joe Spitzen, Assistant Manager of the Regional Housing Accelerator Program at the Nebraska Investment Finance Authority. Due to the pandemic, NIFA is postponing its 2021 Annual Housing Innovation Marketplace Conference until March 28th, 29th, and 30th, 2022. In its absence, we'll be bringing you this series of webinars throughout 2021. Before we continue on, I'd like to thank our sponsor, Westgate Bank, and show you a brief video they provided us.
Joe, can you see my screen?
I can see your screen. I see a blank screen.
Rest easy when buying your first or forever home with a mortgage loan from Westgate Bank. Our local Nebraska experts will be with you every step of the way, from pre-qualification to closing on your dream home, all while helping you navigate any decisions and understand your options. Our experts are local. They know the market, they know Nebraska, they know you. Download our mobile mortgage app at mobilemortgage.westgate.bank or visit us online at westgate.bank. Start your mortgage loan at Westgate Bank today.
All right, thank you, Westgate, for your continued support. Our speakers today are Danushka Nanayakkara of the National Association of Home Builders and Dr. Eric C. Thompson of the Bureau of Business Research at the University of Nebraska-Lincoln. Also with us behind the scenes is Susan Poulos, NIFA's Outreach and Community Development Administrator and the organizer. Susan will be helping us to monitor the chat and answer questions. We would like to have attendees save all questions until the end of the presentations. You can use the question feature on the right to input your questions, and NIFA staff will hold those until the end of the presentations. If you would prefer to ask your question out loud, simply raise your hand and we can unmute you, but keep in mind the webinar is being recorded and will be available online. Thank you all for attending. Our first speaker today is Danushka Nanayakkara, Assistant Vice President for Forecasting and Analysis at the National Association of Home Builders. Danushka oversees the activities of the Forecasting and Analysis section of the Economics Group, which includes housing market analysis, industry surveys, and developing and maintaining national, regional, long-term, and remodeling expenditures forecasts. Before being promoted to Assistant Vice President, she worked at NHB as a senior economist, responsible for state and local analysis. She holds a bachelor's degree in economics and business administration from Otterbein University and a master's degree in applied economics from Johns Hopkins University. All right, you are now a presenter and the floor is yours. Thanks, Danushka.
Thanks, Joe. Thank you so much. Let me quickly switch to my slide deck. Okay, so I have a lot of information that I'm going to cover today. I have about 30 minutes. So what I have done is broadly break the housing sector into four different. So I'm going to first touch on the macroeconomy, then talk about housing demand, supply side issues, and then bring everything together with our forecast. So I just need you to bear with me. This is a lot of economic information, but I promise you it's going to be fun. So hold your questions to the end and we will get started. So first up, the virus is the biggest wild card right now. Unfortunately, we have over 30 million coronavirus cases across the country right now, with over, I think right now it's like 540,000 deaths. So we are hoping, this is the optimistic case, we are hoping 50% vaccination rate by the end of April and probably 75% of the population by, through the start of fall. The biggest worry here again is the virus mutation. We simply do not have enough information to know about them if the strains are vaccine resistant. But I think, the big pharmaceutical companies are working on it and hopefully it will be under control by the end of fall. So with that in mind, we are expecting accelerated growth in later this year, and the interest rates are going to go up, and it is already going up right now. And what that means is, the home sales growth is going to slow down because of the rate range and the inventory shortages. For single family and remodeling construction gains for this year, but slower growth compared to 2020. And again, housing affordability is in the forefront. Last year, the home prices were up 8%. Inventory is low, around 2 months of existing home sales. Interest rates are rising, and the home builders are worried that the regulatory cost issues and the labor and environmental issues are also going to contribute to the housing affordability erosion. So with that in mind, this is what the GDP data looks like. Third quarter, you can see the sharp rebound at 33, almost a little over 33%. It was the fastest growth rate record since the quarterly GDP data was first tracked since 1947. And the fourth quarter was at 4%. So for the full year, real GDP contracted 3.5% in 2020, compared to a 2.2 increase in 2019. And this marks the first contraction since 2009 and the worst recession since 1946. The economy is expected to rebound in the second half of 2021, but as I mentioned before, risks remain. So 2021, we expect the year to end at 5.4% and 2022, 4.3%. The biggest problem here is this is not a normal downturn. A normal downturn is usually caused by an imbalance in the economy, like a credit bubble or a housing bubble. So the recovery in a normal downturn follows a standard path. This downturn is caused by public health policy, so we are in a highly uncertain economic environment right now. Looking at the GDP data, it's showing resilience in the goods and the services, right? The goods services have rebounded, especially durable goods, you can see. But unfortunately, the service sector is still hurting. This is the unemployment data. The February unemployment data, it was an increase by 379,000 jobs. It marks the second consecutive gain after a decline in December. The unemployment rate is at 6.2% right now. So looking at 2020, it was like a year like no other. The economy lost 22.7 million jobs in March, April, and December because of the pandemic. In the past 10 months now, 13.2 million jobs have been recovered. But looking at employment a year ago in February, we are still 9.5 million jobs lower compared to last year, February. This is the monetary policy. The federal funds rate is at 0 to 0.25%. So overall, the Fed has done a fantastic job responding to this crisis by providing various avenues to access liquidity, including cutting interest rates to near zero, creating a incredible variety of emergency credit programs to promote lending to households, to businesses, state and local governments, and also conducting large-scale asset purchases. This is the interest rate. Mortgage rates, ticked again higher last week, making home buying even more expensive. And at the start of the all-important spring market here, right now we are forecasting this year mortgage rates to be around 3.25%, and for next year to be a little above 3.5%. Still historic lows if you look at what the rates were in the 1990s. So I hope that gave you a quick recap of the macro economy. Let's move on to housing demand. So this is consumer confidence, and not a surprise, 2020 consumer confidence have declined because of the pandemic. We've seen the spending patterns different based on how long the individual is unemployed. If it's less than 6 months, we've seen that, no fundamental differences in consumer spending. However, if an individual is unemployed for longer than 6 months, it takes longer time for spending to get back to trend. This, I want to show you what the household balance sheets look like. This is debt as a share of disposable income. It's in pretty good shape. The current cycle is very different from a typical recession, right? Household wealth is rising, debt levels are going down a little bit, and it has increased a little bit towards the end of last year, but still in great shape. So the financial assets and the rising home prices are contributing to net wealth gains. But however, the problem is, many of the at-risk households towards the lower end of income distribution, so they have smaller assets to which they can count on. Still, it is worth noting that the net worth of the bottom 50% of the households have improved over the past few years, making it that, they have a sturdier financial cushion for low-income households during this crisis. And access to credit remains available and historically inexpensive, like I showed you in the couple of previous slides. Even though, the tight lending standards could make access that mortgage rates right now could be difficult, particularly for the lower income households. So if we broadly define, break down consumer debt, it is primarily student loans, auto loans, and credit cards. So among the household, most of the debt has been concentrated in student loans and auto loans. I'm sure this is not a surprise to you. And this is a concern during a recession, especially for the young adults here. So the student and auto loans, they crowd out home purchases and will likely to weigh on consumer spending for years to come. So student loans are up 155 points, but higher decrease usually means higher lifetime earnings. The concern here is the dropout rate. Nearly 1 in 3 drop out entirely. The issue is that this group will have student loans, but will not have high lifetime earnings to show for it. The auto loans, the increase in auto loans is because of the 6 to 7 year car loans with no money down are contributing to the increase in auto loans. And the risk of default is, if you default on these two types of loans, it is hard to qualify for a mortgage. This is looking at household formation data. Before the Great Recession, an average of 1.3 million households were formed on average. During the Great Recession, it dropped down to little above 500,000. And right now we are at 1.4 million, but we still need to be above this considering population increase. One of the reasons that we haven't seen many more households is the fact that the share of young adults living with parents. So this essentially shows missing households. The 18 to 24 here is not a concern because they're in college. But look at the age of 25 to 34. They're out of college, but still living at home. So it has almost doubled over the last decade and a half. So in 2000, little more than 11% of the individuals in this age range lived with their parents. In 2019, it has increased to 22%. So that is 5.6 million more young adults are living with their parents. So Freddie Mac actually had a report about this. They said that over 400,000 additional households headed by 25 to 35-year-olds would have formed if not for the high housing costs that has resulted them from choosing to live with their parents. So we are hoping that this could be structural. They're waiting to find jobs, so they're unemployed. But our worry is that this could be structural, that this could be a new normal. This is household formation data broken down into own-occupied versus rent-occupied, and look at 2020. I think the renewed interest in housing is shown here. Everybody was running to buy a house last year, and I think that shows here in 2020 data. Look at the increase in own-occupied and the decline in rent-occupied market. This is the home ownership rate. The peak was in 2004 at 69.2%. Right now, it is at 65.8%. We're kind of concerned with the large volatility here because the drop in 2020 is really it's a large magnitude. And we think that this could potentially reflect the data collection challenges during last year because of the pandemic. I want to show you this one. This is the housing affordability, and we track that at NHP by the NHP Wells Fargo Housing Opportunity Index. So despite the low mortgage rate, the supply shortage coupled with the rising home prices have contributed to the decline in housing affordability. So the home prices are rising faster than household income. In the last quarter of 2020, the housing affordability, the HOI, was at 58. So what does 58 here mean? Only 58% of new and existing homes are affordable to a typical family earning the median income of $73,000. So the HOI here also captures the national median home prices. It jumped to an all-time high in the fourth quarter to $320,000. And if you look at the year over year, it has the HOI is actually has changed, but it just shows that the home buyers continue to face ongoing challenges in terms of limited inventory, especially among the starter homes of prospective home buyers. And what happens is, the declining housing affordability means it puts upward pressure on rental demand, and we need more affordable rental housing as a result. We're talking about increase in house prices. So you can see here that the home prices have been pushed up because of tight inventory mainly. So we are forecasting at NHP the house prices to increase 4.5% for 2021 and 3.5% for 2022. This is existing home sales. This shows here the existing single-family home sales. And just 2 days ago, the existing home sales, total existing home sales came out. It actually dropped in February, 6.6%. And the rate right now is 6.2 million annualized rate. And the decline is not because of a drop in demand, but because of there's no more houses. So we have, I think the chief economist, Lawrence Young at the Realtor said, it's historically low inventory has what caused the existing home sales to drop. But if you look at year-over-year basis, sales are 9% higher than a year ago. So again, low inventory is continuing to drive up the home prices, and the median price for single-family home was up 16% from a year earlier. And you can see, this is pricing out the first-time home buyers for sure. Looking at new home sales, it came out yesterday, February. It was 12% lower than a year ago, and the rate was at 775,000 annualized rate. So the higher interest rate and the supply shortages, rising material prices, particularly for lumber, has put in a damper for new home sales in February. So the current month supply is at 4.8 months. At the same time, there's only 42,000 completed, ready to occupy new homes available nationwide. So I have covered the macroeconomy, covered housing demand. So I have two more things. We're like halfway there. So just, bear with me here. So we're going to go on to the supply side factors. So this is an NHP survey that we did, and we asked our builders, what are the challenges that have been brought on by the pandemic? And they said, the shortages of delays in obtaining building materials, that's the biggest issue that they're having. Local jurisdictions having trouble processing approvals in a timely manner, difficulty finding labor and subs willing to report to construction site. This has been an ongoing, the lack of skilled labor has been an ongoing issue for a long time. And the new ordinance is making development and construction more difficult, lots not coming in. So these are the issues that have been going on for a while, but the pandemic has actually made it even worse the last year. So the top issue is lumber. Lumber prices have skyrocketed more than 109, like almost 200% actually, with 197% since last spring. And because of this, just the lumber price increase, it has, the average price of a new single family home has increased by almost a little over $24,000 just because of lumber price. And it appears that the lumber prices are higher because of the supply shortages and the high demand for it. I think everybody was doing their renovations and building new homes last year. So this has caused the lumber prices to spike. So until those are smoothed out, we will see price volatility. So because of lumber, building material prices, the whole index climbed 8% over the past 12 months. Construction, right now, there are 309,000 jobs open in construction. This includes residential and non-residential. So employment in construction declined in February because of the severe winter weather in many states, particularly in the South. So right now, we have estimated that, the BLS have estimated around 475,000 residential construction jobs have been created in the past 9 months. So by the end of 2020, this is a remarkable thing here. Job gains in residential construction offset all the jobs lost in March and April. This is the residential construction. While non-residential construction jobs, only 61% have been recovered. So builders have plenty of projects that they're hiring, but finding it difficult to fill these job openings. The Great Recession happened and it was devastating to the housing industry, and many just left the labor force for good. And we have an aging labor force. We need young people interested and coming into the trades and construction trade. And of course, women make up only around 9% of construction labor force, when women make up almost half of the entire labor force. And also the immigration crackdown has also choked up new labor supply. So these are the factors that are causing, the lack of skilled labor in this country it's been a while now, for at least 4 or 5 years now. So this is what the labor situation looks like in construction. And lending. This is acquisition, development, and construction loan. So lending is twofold, right? On the consumer side, it's mortgages, and on construction side, this is the AD&C loans. So this here is the Senior Loan Officer Opinion Survey on Bank Lending Practices and the NHB survey. That's the NHB survey is plotted out by the red line here. So positive numbers here means that the lending is tightening. So look at the time between the Great Recession, right? So the negative numbers, that's what we want, is less restrictions on lending. So the AD&C loans are expanding. So we are seeing that the easing trade conditions are reported by the NHB survey. You can see in 2020, the line is actually going up, the red line. And this is important because access to financing is very important, simply because 75% of home building is done by smaller builders. They're the non-publicly traded companies. So they need access to financing in order to build the homes that we desperately need. I mentioned the lot shortages before. 58% of the builders are saying that there's a low lot supply. That is shown here by the red bars here. That's a survey that we say, and I have plotted this with the housing starts to show you before, the Great Recession, it made sense that the builders are saying that there's a low lot supply going on, because look at the blue shaded area, right? Housing was booming. But right now, we haven't seen construction back to the pre-Great Recession levels, but the builders are still saying that there's a low lot supply. So what we need is more efficient zoning rules, land development rules, and lower impact fees to bring more land into the system. And the lot shortage have contributed to increase in lot value, which in turn means higher house prices. Another area that actually is contributing to the increase in house prices is regulatory costs. It is up 29% over the time period between 2011 and 2016. We are actually doing an update to the study. So hopefully this year we will have the results of that. So this is the regulatory cost as a share of home price. So the average is close to 25%. So that is 10% during construction and 15% during development. And you can see that the lower quartile is can be around 14%, but it could go as high as 30%. So this is for the single family home. And this is the multifamily development cost. 32% of multifamily development costs are because of regulatory fees. So the average is 32. Lower quartile is like little close to 22%, but it could be high as almost 43%. So we do need to figure out how do we bring these regulatory costs down. Okay, last section. So we have covered the macroeconomy, housing demand, supply side issues, and then let's look at what the construction outlook looks like. So I want to show you what the long-term housing looks like. This is shown by population because population is the primary driver in rental and home-occupied markets. So this is the U.S. population profile. We have the silent generation, the greatest generation, silent generation, baby boomers, Gen X's. They are the majority of new construction home buyers. And then the millennials, they are the group born between 1981 to 1996. They are the largest living generation right now. 27% of the U.S. population are millennials now. So they are in peak home buying years. Peak home buying years are defined as 25 to 45. So the oldest millennial will turn 40 this year. So they are, if you look at that, just look at the pent-up demand that's going to come through in the next decade just by the millennials. But then the Gen Zs are right after that. The oldest Gen Z is probably finishing up college right now. So they will also be entering home buying years right now in a couple of years. So there is an incredible amount of pent-up demand. It's just that we need houses, we need inventory, we need more houses in the system. Otherwise, what happens is demand is higher than the supply, and it will push house prices up further than it is right now. Before I go on to the single-family starts, I want to show you the HMI, that is the NHB Wells Fargo Housing Market Index. This gauges the sentiment of the current single-family home sales and the sales expectations for the next 6 months. So it's an index. So the number above 50 indicates that more builders view conditions as good. Lower than 50 indicates that the conditions are worsening. So despite the historic high buyer traffic and the strong demand, the builder confidence actually fell in March to 82. So what's the issue here is the material cost, particularly lumber, and it has depressed the builder sentiment this month because of the supply side issues. So with that in mind, this is the single family forecast that we have. 2020, 12% increase compared to 2019, and we have touched 1 million, which is fantastic because this is the first time since the Great Recession ended that housing starts have been at 1 million or above. So 2021, we think it's going to be a 6% increase. And then 2022, we are actually forecasting only 1% increase simply because of the supply side issues. We think it is going to hamper the construction. If you look at the single family permits, these are the top 10 largest single family markets. Houston is up 21%. This is year-to-date permits, comparing to 2019 December. Dallas is up 25%. Phoenix is up 27%. Atlanta up 7%. Austin is up 19%. Charlotte is up 19%. Tampa 9%. Orlando is up 3%, Nashville is up 5%, Washington is up 9%, Washington DC area is up 9%. You can see just by the permit, the demand for housing. That's why I wanted to show you here the large, double-digit increases compared to 2019. Townhouse market, expanded to a 2.5-year high at the end of the last year. So townhouse, it actually was up 36% higher than the fourth quarter in 2019. So we think this is a great bridge between being a renter to a homeowner. And this is also great if you are not able to afford a detached single family. Townhouse is an excellent way to get into your first time home buying. And we do think that, townhouse construction is going to further expand given the demographic of renters, especially the millennials, the younger millennials and the older Gen Zs. And because of the land constraints and the growth of demand for walkable neighborhoods, this is a great area for construction. And also the construction costs are lower for a townhouse because the square footage is lower. So that is something to keep in mind too. Single family built for rent. This niche market has received a lot of attention as a means to add single family inventory because of the housing affordability concerns and the down payment requirements for sale markets. But it is still less than 5% of the single family housing. So I showed you the HMI. This is the multifamily counterpart. This is the multifamily production index. And this gauges the builder sentiment on the apartment and the condo market. So the index, again, above 50 means the conditions are improving. Below 50 means that the conditions are declining. So the confidence in the market fell 5 points in the fourth quarter to 43. And the MPI is a weighted average on 3 key elements, right? It is the construction of low rent units, market rate rental units, and for sale condominiums. So all 3 components posted the decrease in the fourth quarter. So we take this into consideration when we actually do our forecast. So 2020, the multifamily market declined 2%, but it was coming off the high, the peak of the multifamily construction at 403,000 units. If you look at this chart from 2000 onwards, you can see that the multifamily has recovered since the Great Recession, and it peaked in 2019, unlike single family, which never recovered to the peak housing years. So 2021, we think it will be around 7% decline because of the, we do expect the rent growth to slow down and the vacancy rates to increase. And maybe the tenants are shifting their preferences from multifamily rentals to single family rental as well. But we do think the market strength for the construction for apartments in the outlying areas and return to trend after the vaccine. So that's why you see a 4% gain for multifamily construction next year. This is the 10 largest multifamily markets by permits. This is also the year-to-date percentage changes. New York is down 13%, Houston is down 8%, LA is down 15%, Dallas is down 41%, Seattle is down 17%, Minneapolis is down 11%. Austin, on the other hand, is up 38%, Phoenix is up 42%, Miami is up 2%, and Nashville is up 36%. Multifamily units completed by units per building. So I wanted to show you this because in 2019, the 50 plus unit buildings were majority of the market share of the multifamily, and they were only like 10% in 2000. So because of COVID, we think that it could generate market share gains for smaller multifamily structures, including the garden style and the low-rise buildings. Those are the purple, green, and the red bars. And we do think the decline for 50 plus unit market for the next couple of years. If we break the multifamily construction into build for rent and build for share, build for rent dominates multifamily construction. It is at 97% of market share. And the condos, the for sale multifamily is only at 3%. So during the last quarter of 2020, there were only 3,000 multifamily units started, as opposed to 84,000 rental apartment starts. This is the remodeling market index. Remodeling market index has posted solid gains and the solid confidence that the remodelers have for the projects of all sizes because of all the remodeling that was done last year. So because of it's at 79, we take this into account into putting our remodeling forecast. And 2020, it was at 7% increase, and 2021 and 2022, 6%, and a little bit of decline for next year. And we do think that the remodeling growth will continue because people are using their homes for more purposes right now. And this is the 2020 pandemic. This is also a survey that we did about the buyer preferences. So because of the pandemic, the builders are saying buyers are asking for home offices, homes built in the suburbs, and they want, the outdoor spaces and home builds in the outlying rural areas. And, they want high-speed internet, large kitchens, and the energy efficient features, larger homes, exercise rooms. I think none of this is a surprise. We've all been stuck at home for a year now, and we've all been dreaming of bigger spaces, right? So I think this shows in this survey. Last thing I want to show you is the economic impact of home building. So the new estimates show that building an average single-family home generates 2.9 jobs. This includes substantial number of jobs in construction, manufacturing, building products, transportation, and professional services such as architects, engineering, financiers, and real estate agents. So in summary, home building generates an attractive mix of jobs to support a healthy national and, most importantly, a local economy, especially during a period of recovery. Thank you so much.
Thank you, Danushka. Next up is Dr. Eric Thompson, who is the Carl H. Nelson Professor of Economics and the Director of the Bureau of Business Research at the University of Nebraska-Lincoln. Dr. Thompson's research on the national and Midwest economy examines competitive factors affecting state and local economic growth. Dr. Thompson holds a PhD in agricultural economics from the University of Wisconsin-Madison. All right, Eric, you now have control. The floor is yours.
Okay. Well, I have a PowerPoint presentation. Is that visible now to people?
Looks good.
Okay, great. Well, I appreciate the opportunity to present today. Really would like to follow up on state economic conditions. So that was a very thorough presentation on factors affecting the housing industry. My presentation will talk a little bit about the construction industry in Nebraska, but we'll be more focused on just general economic conditions in Nebraska and how they might compare to the nation. So just briefly discussing what happened with the Nebraska economy during 2020 as the COVID pandemic impacted our state's economy. Obviously, we were impacted as well. This was a pretty significant impact on the economy. I guess this is the second recession in a row that's been a very severe recession, so it creates very challenging conditions. Now, the initial economic contraction was less severe in Nebraska. It was about 8% of employment back in April and May. So in our worst month, our decline in employment was actually slightly less than the current national decline in employment, even though nationally employment has recovered quite a bit. But we at our peak were only down 8% here in Nebraska. Nebraska has already covered about 75% of those jobs, sometimes a little more than that, sometimes a little less than that in the month-to-month data. But we have about 20,000 jobs still. We're still 20,000 jobs behind where we were back in February 2020. So why this smaller impact on the Nebraska economy? Well, I think a big part of it was Nebraska just had a smaller share of its economy in some of the most heavily impacted sectors. So obviously travel and tourism, including major tourism attractions and entertainment centers, obviously were significantly impacted by the pandemic, especially early on. The casinos in Las Vegas were closed for several months. Big reduction in air travel and people going on vacation to popular destinations like Florida, California, and so forth. And Nebraska has a lot of nice tourism destinations, a lot of great things to do, but it just isn't as large a part of our economy as it is in some parts of the country. We also have a significant airport in Omaha, and as well as an airport in Lincoln and local airports in other parts of the state. But again, we're not a major airport hub like Salt Lake City or Chicago or Atlanta. And so we weren't quite as impacted by the decline in air travel as well. Our decline in air travel is just as significant here in Nebraska as around the nation, but it just isn't as big a part of our economy. Another sector that early on was impacted heavily was automobiles. Nebraska is not a center for automobile parts or automobile assembly. Also the oil industry was heavily impacted. If you remember that month back in 2020 when the price of oil actually turned negative for a day, and oil prices were way down, production was down. Again, Nebraska is not a big oil production state. We don't manufacture a lot of parts for the oil industry and a lot of equipment. So some of these most heavily impacted sectors are just a smaller part of the economy here in Nebraska. At the same time, we have a larger share of our economy in the sectors which were hit less hard. I mean, all sectors were affected to a degree, but what does Nebraska specialize in? Well, food production and processing would be one sector. Well, there were certainly some challenges in food production and processing if you think about how the COVID cases spread in the meat processing plants. And that was a really difficult thing for people in our state and for the industry. And some of the plants had to be closed for at least for temporary periods, and that impacted back to the livestock industry. So there were some challenges, but by and large, food production and processing were a lot more stable during the pandemic than many sectors of the economy. Obviously, agricultural production, social distancing is not much of an issue typically, since people work independently on farms and ranches to a large degree. So that, coupled with the fact of stable demand, even rising demand to some degree for food production and processing during the pandemic, meant a more stable economy, a less impacted economy in Nebraska, since we have much greater specialization in those sectors than the typical state. Nebraska is also a home for the finance and insurance industry. Insurance carriers certainly are concentrated in Nebraska relative to the typical state. We have a large finance industry as well. In these industries, there's just much greater potential for people to work at home. So there was less disruption to employment from people working at home. So again, why was Nebraska less heavily impacted than the typical state? Well, we have a smaller share of our economy in the most impacted sectors, and we have a larger share of our economy in the least impacted sectors. But I think there were other factors that led to the lower impact on the Nebraska economy. Chief among those is, I think, consumer reluctance in the face of the pandemic may be lower in Nebraska and maybe some of the other states in this part of the country than it is nationally or in some of the other states. So what I mean by reluctance is Nebraskans were a little more reluctant to change their behavior in the face of the pandemic. And I'm not talking about wearing masks and things like that. It's more changing their behavior as a consumer. So Nebraskans were somewhat more likely to continue shopping at retail stores in person, more willing to patronize restaurants, more willing to continue to patronize other types of entertainment businesses. During the pandemic, obviously Nebraskans were also concerned about the spread of the pandemic, but that reluctance may have been less in Nebraska than a typical other state. Now, maybe that's partly related to the fact that we're less densely populated than most states, but it may just be a somewhat different approach than you might see in states like Massachusetts or Washington State or Illinois or some of the other states in the country. Obviously, if that's sort of the philosophy or approach to people in the state, they're more likely to have a state government that shares that philosophy. And so the public regulation on business also was lighter. I wouldn't say it was light, but it was lighter in Nebraska than it was in some of the other states around the country. So, more businesses were open, or they were allowed to stay open at a higher level of capacity sooner here in Nebraska. So that combined with customers that are just more willing to patronize the business despite the pandemic were a big part of it. Now, at first, I had kind of wondered, well, maybe Nebraska was the economy was less impacted because the pandemic wasn't as severe initially here in Nebraska as it was nationally, but we saw later in 2020 it was quite severe in Nebraska, perhaps more severe than in a lot of other states, and I think that reluctance remained lower. So I think that was an important factor as well as the industry structure of the state. Now, I think looking forward, these were advantages Nebraska had in terms of the economy, in terms of limiting how large the impact was on our state economy and helping us recover a little more quickly from our job loss. However, I think we've already seen the benefits. So we've gotten 60 of our 80,000 lost jobs, 6% out of 8% of the lost jobs have returned. But I think the last last quarter of the jobs are going to be harder to get back. These advantages we've had may not be quite as important going forward. It's going to be challenging, I guess, as it is at the end of any recession, to get some of the unemployed folks back to work. So our economic decline wasn't as severe as it was in many parts of the nation in 2020, but I'm not sure our growth is going to be as strong as it will be in other parts of the country going forward in 2021, 2022. We'll have pretty healthy growth, but it may not be the boom that some states are expecting in the second half of 2021. Again, just like in other states, just like here in Nebraska in past recessions, putting people back to work, sometimes in new occupations or, most cases with new employers, but even in different occupations and industries is going to be a challenge for us over the next year and a half. So let's look briefly at some of the Nebraska sectors and see how they've fared and how they're expected to fare here in the coming year or 2 years. So retail trade, like many parts of the country, although not as severe as in some other parts of the country, retail trade employment certainly declined in Nebraska in 2020. The revised data on for 2020 is actually going to be out later this week, but we don't know exactly how much retail trade declined in 2020. But it was a pretty significant decline. We should have that data at the end of this week, the specific percentage decline. And of course, here in Nebraska, we may not have been quite as reluctant, but consumers did avoid retail activity in the initial months of the pandemic. By that, I mean in-person retail activity. And the pandemic probably accelerated the long-term trend to e-commerce. There were perhaps some older people, I'm speaking of myself now, I didn't have a lot of experience with e-commerce before the pandemic and may have tried it during the pandemic, and there may be some people that they moved to shopping online much more quickly than they would have absent the COVID-19 pandemic. So I think we have seen an accelerated transition to e-commerce, and then just ongoing trends of automation in the retail industry as labor is an ongoing challenge for that industry as well. We heard earlier how it's a challenge in the construction sector. And so I don't think we're going to get back all of the retail employment that we lost in 2020. I do think retail employment can grow at a healthy pace by about 2.5% in 2021. But after that, I think it'll start to fall again in 2022. So retail trade activity will continue to hold its share of the economy. Again, a little bit less bricks and mortar, a little bit more towards e-commerce. But in terms of employment, I think we're on a long-term trend of a declining retail employment here in Nebraska, at least. Services employment also declined sharply in 2020. Obviously, sharp drops in restaurant employment, lodging, other arts and entertainment businesses during 2020. A sharp drop in personal services, that's things like beauty salons, nail salons, barbershops, etc. So these activities dropped sharply in the early months of the pandemic. We've seen some recovery, but if you look at 2020 as a whole, those are down. I think we've had some persistence in consumer reluctance. Again, I think reluctance is less severe or less of a factor in Nebraska than it is in some states, but even here in Nebraska, we do have a segment of our population that is reluctant, is changing their behavior in the face of the pandemic. And earlier this year, the pandemic was again quite severe in Nebraska. I think there's worries that it could get more severe again with the variants spreading. And so we may continue to see an impact on demand, not from the whole population, but from significant segments of the population for things like restaurants and lodging and entertainment businesses. That said, I think services will resume their role as a growing share of employment and probably commercial space in our economy here in the state. And we're expecting quite healthy growth in services employment over the next few years. Nebraska Agriculture, obviously a big part of our economy. The COVID-19 event dramatically affected commodity markets and price prospects in early 2020 when the pandemic started. Obviously, we talked earlier about the virus outbreaks and how that affected meat processing plants, the workers, terrible impacts on the workers in those plants, and also leading to a need for some closures for several weeks in some cases, which had impacts then back to the livestock industry here in Nebraska. Also, the ethanol prices were severely impacted by the decline in travel in the global economy back in the early days of the pandemic, and that obviously affected the gasoline and oil markets and also affected ethanol. That said, government payments, at least to agricultural producers, helped limit farm and ranch losses in 2020. As well as we saw some ongoing payments related to the 2018-19 trade war that the payments were made in 2020. So those, as well as support payments for agriculture related to the pandemic. So that softened the blow earlier in 2020. And then, of course, we've seen a surge in ag commodity prices in late 2020 and 2021. And this suggests that farm income will rise sharply in 2021 and in 2022. Well, it'll rise sharply in 2021, and then that higher income level will be maintained in 2022. We think farm income can reach $5 billion per year this year and next, which is more than double than we've seen in some of the weaker years that we've experienced recently in our state. So this is one positive for the Nebraska economy. It's hard for the Nebraska economy to be very strong without a strong ag sector. So it does seem like the ag sector is going to be a big positive for our state in the next few years. Manufacturing is also a big impact in our state. We have the same size manufacturing industry as most other states, plus we have a much larger ag industry, a larger transportation industry. So Nebraska is very much a blue collar state in a lot of ways. So manufacturing obviously was impacted, especially in the early days of the pandemic, by the global recession, but the industry also benefited and continues to benefit from a number of factors. Low interest rates, of course, those have come back here a little bit recently, but they're still quite low. That's obviously good for durable goods purchases among households. A weak dollar has benefited in terms of the terms of trade, benefited our manufacturers, and then people spending their stimulus payments. Some of that remodeling we heard about in the first presentation was probably related to that, and we might have a boom in remodeling again this year as more stimulus payments are made. So going forward, we think we can have what's for Nebraska a healthy gain in manufacturing jobs, 1 to 2% in 2021, and then maybe a slower gain in 2022. But that's a manufacturing employment. Manufacturing activity, like agriculture, will be a positive for our state going forward. Quick look at some other sectors. Construction continues to be a healthy sector here in Nebraska. We do struggle with labor, as is the case nationally. Manufacturing and construction used to be the prime employers that people wanted to get into 20, 30 years ago, or perhaps even more recently. But as the economy has changed, wage growth has been a lot stronger for people with jobs requiring college education rather than blue-collar jobs. And so construction and manufacturing these days, and I expect this to be true going forward, are among the sectors that really have to compete for their workers. Historically, they were the target sectors for workers, the pinnacle industries that people wanted to get into, but now they're just kind of one of the gang, construction and manufacturing, and they'll have to fight for workers as many industries have had to in the past. Transportation and warehousing should have solid growth, and we're expecting continued strong growth in financial services. As I indicated, Nebraska has a strong financial services sector. In terms of the overall economy, we think Nebraska employment can grow by about 2% in 2021. Again, we didn't have the severe job loss seen in other parts of the country, so we won't have quite as quick a recovery in 2021. The other part of it is I think we're down to the 20,000 jobs or so. That's going to be more challenging to get back. We think we can have strong job growth in 2022. I think in late 2021, by late 2021 or early 2022, Nebraska will be back to its pre-pandemic employment level. However, it's going to need to have fast job growth for several years to get back to full employment and get employment back to where it should be according to its trend. By the end of 2022, we shouldn't have the same employment we had at the beginning of 2020. We should have 1 to 2% more employment. So we're going to have fast job growth for a few years to get back to that trend level. But we do think we can get back to pre-pandemic employment at the end of this year or early 2022. Just a note on farm income. So non-farm income actually grew rapidly in Nebraska, as it did in many states, due to the sharp increase in transfer payments in 2020. The economic impact payments, we used to call them those one-time checks. Now we've ended up having 3 rounds of those one-time checks, as well as extended unemployment insurance benefits. Those aren't quite as large as they used to be, but they are continuing at $300 rather than the initial $600 a week. These transfer payments will be maintained in 2021, as we know, even as wages recover further. So 2021 will be a good year for non-farm income as well as farm income. Now, income might actually decline in 2022. Wage income will continue to recover, but as those transfer payments are withdrawn, it might be that total income in 2022 is less than it was in 2021. However, I still think that the transfer payments that people received last year and will be receiving this year will buoy spending in both 2021 and 2022. I don't think all those transfer payments will get allocated and spent right away, and it'll actually support spending over the next few years. So income might be down in 2022 compared to 2021, but spending will remain solid in 2022. Okay, well, those are the main points I wanted to make, and I see it's 11 o'clock now, so I'll go ahead and turn the program back over to our moderator.
Thank you, sir. I appreciate it. Danushka, we will go through some questions together as a group if you'll rejoin us. Thank you, ma'am. Just a couple questions from our audience. First one is, builders say there's a shortage in lot supply, and how does that actually compare to available lots and not your presented building permits? He said that in Lincoln we have a 3-year supply of single-family home lots with utilities, and we still hear there isn't enough lots. How much ready supply is needed to move the perspective?
I'm not really sure. I can't speak just for your local area, but what we, as a national level, is what we know. We see the surveys, and it's the buildable lots, not exactly like available lots. We need to have like all the, the electricity, the water, everything connected. That's what the builders are saying. We need buildable lots, available lots. There's a difference, but I can't really speak for your local area, unfortunately, because we do these surveys at the national level. I know it's not a very helpful answer. I can see if we can find some other information, but I'm not really sure what I can say at the local level, though.
Thank you. Got one saying, I didn't see a comment from Dr. Thompson on housing demand and supply in Nebraska. Could he address that?
Well, generally speaking, Nebraska doesn't have as wide swings in price and availability as you see nationally. So our builder community is conservative in some sense, so they don't tend to expand construction quite as rapidly during positive periods like you might see in cities like Phoenix or others, and as a result of that, there's maybe somewhat less of a downturn during the difficult periods here in Nebraska. That said, obviously we are impacted by national trends. We do face the supply and demand challenges that we're seeing nationally. We have had price increases here, but the severity of those problems isn't typically as extreme in our state.
One is, with many baby boomers passing 80 years and expiration rates increasing, how will turnover of that generational housing affect the demand within the market?
Well, I can say a little bit today because we're hoping the baby boomers will actually downsize. And funny thing is, we had, I didn't include that survey here, 55 plus rental survey we do. It was actually a very healthy point. Baby boomers were actually selling their homes and moving into rental apartments in more downtown areas where they could probably go to the theater and restaurants and enjoy living in a city, but unfortunately, because of the pandemic, it kind of reversed course, and they are hanging on to the larger houses. And most probably, what we're seeing in the share of young adults living as well, because that's also at elevated rates. If you are like the kids were in college, they're most likely have moved back home with the parents, and they're waiting for jobs. And so, yeah, they are hanging on to the houses much longer than in previous years that we've seen. So we would love to be able to say, you know, see in the data that they're actually downsizing, but we don't see that yet.
I was thinking about that during the presentation because I have one grandma who moved into a single family or a single bedroom apartment just as soon as the kids were out of the house. And my other grandma downsized to a ranch that was just as big as her previous house, but avoided the stairs and lived there for the rest of her life. Do you see numbers actually changing in that direction? Or
so the housing stock right now in the US, the majority of the houses are over 40 years old. So that means that, you know, people are staying in longer and longer without doing any major work in order to sell those houses. So I'm not sure if Eric wants to jump in here and say if he has seen anything.
Well, yeah, I would simply say I think there's always been a number of older people that are reluctant to leave their home. And I would expect the experience of the last year is going to drive that up quite a bit. Nursing homes are certainly not going to seem very appealing, but even more densely occupied apartment buildings may not seem all that appealing either. You know, I don't know that the boom of communities designed for older people seems to have abated a little bit, at least up here in the Midwest. I don't see as many of those going up where, you know, people start in their own apartment and then maybe move within the community as they age further. You know, the other factors is we've had quite a nice run in the stock market if you take like a 30-year view, and the wealth is there to allow people to stay in the home if they would like to, and that probably is going to be maintained for a few more years here. And then, of course, people are just healthier in at least the people who are still with us are healthier than they would have been 30, 40 years ago, generally speaking. And so I think all of those things are pointing to the trend that Danushka mentioned of people just staying in their homes longer and longer, especially if they think they can make some more money by staying in them as housing prices rise.
do you think that will shift with later generations based on values, on how younger people might value more being near urban cores, having more amenities rather than moving to the suburbs? Or do you think there's just going to be a shift in values that they have as they age and their values change?
Yeah, I think I think there are shifts, but you know, here in Nebraska, we have capacity to have more density in the form of single-family homes in our cities. And I think the other thing is that absolutely, I think there are differences between the generations and attitudes about where to live, but more than that, there's just differences among people at different stages in life, and younger people who fiercely subscribe to urban living, more towards the urban core, unexpectedly find their attitude changing when they get older. I think I was one of those people. And so if there's a long-term trend, I think it'll be slow enough that the housing stock will be readily able to adjust. The other thing is, you know, the self-driving electric car is coming. So even if people are concerned about the environment, well, if their car runs on solar energy, that long commute might concern them less, and a long commute may waste your time less in the future if you're able to work while you're driving. So I think the suburbs are here to stay.
I agree with Eric because I live right out of DC, and everybody flees DC when they get married and have kids. No one wants to live in DC. They want to live in the suburbs, even if it's, even if it means you are going to drive an hour to go 15 miles, because you have the space. DC doesn't offer that, and I think that's pretty true for New York City or even the Bay Area. Now you've heard so many stories where I think Facebook, Twitter, they're giving people the ability to work permanently from home. So people are moving to, Colorado, Idaho, like pushing house prices there because they are bringing now the West Coast salaries to the mountain states and pricing out people who have been living there for years and years because they are not making San Francisco salaries there. So you see, I think the suburbs are here to stay for sure.
There was something, Danushka, that you had a slide earlier on. It was called a share of young adults living with parents that showed an increase of 18 to 24-year-olds, kind of taking a sharp increase from 2005 to about 2012 and then plateauing, and then a more gradual increase of ages 25 to 34 till it topped off in 2017. I was just wondering if you've seen or do you expect there to be a change with regard to single family homes that are built to be multi-generational?
I actually think that is true because I think the multi-generational households are going to be a pretty normal thing, especially like Eric pointed out. If you have older family members who want to go into a nursing home right now, and if the young adults have children, this would be a great way that they could get some childcare help and then have your parents live with you. I think multi-generational households are going to be a more normal thing in the United States going forward because of the pandemic and the bigger houses. And I think everybody wants a bigger house right now, bigger space. And I know everybody in like our areas, who always like itching to now add more spaces. You can see that from the remodeling and also the buyer preferences. Everybody wants larger kitchens, more outdoor space. The in-law suites are one of the things to the auxiliary dwelling units are increasing as well, according to Freddie Mac. They're citing the granny flat in-law suites too. So yeah, I think multi-generational housing is going to be enormous. So if your kid is living with you in your basement, it might be a permanent thing now, They'll just put you back into the basement and they'll live in the main living area. So.
Yeah, and one of the long-term phenomenon within the economy is that people are moving less than they used to, which, that's a whole other webinar why that is. But I mean, moving cities less often than they used to. And so, if you don't live in the same town as your parents, it's hard to live in their house. So if it's more common for people to be in the same city, then probably more people will take up that option. And so that might be part of it. And that part of it might be more of a permanent effect as well.
We had a question come in earlier that I missed that you sort of answered already. It said, how do you think remote working will affect the housing market? Do you think this could help rural area population? You kind of addressed that already with Bay Area salaries now moving across the country, but I just want to give you a chance to expand on that if you'd like.
I think it's absolutely true. I see it from permits that are being issued. The rural areas have more construction happening right now than before compared to a year ago. Dr. Thompson, do you have you might know more.
I think commuting is the cost of commuting is one of the factors that draws people closer to the city center. Now, what we may see is that the prices will also be affected, so that there may be less incentive to live in the city, but if that means housing gets cheaper in the city, then you may end up with more people back in the city for that reason. But it certainly won't, that's not going to be positive for enticing people to do more new construction in the city. And again, at the same time, you have that going on, you have commuting costs declining with automobile technology changing so fast. So yeah, there could be a further spreading out of the population within metropolitan areas, or at least the new building. The other thing I was wondering about is, there may not be a Bay Area wage anymore. If people can live in Colorado, we may and work in San Francisco, or live in Omaha and work in San Francisco, or have their employer in San Francisco. We may start to see more national wages, which will have all sorts of interesting implications for housing prices too, I would think.
Yeah. And I've heard talking about, you just mentioned that the prices, like, the rents and stuff you would pay in the city to attract. I was doing a webinar a couple of months ago, and the chief economist for Lending Tree was on, and he said he moved down the street in New York City because this new building offered him 7 months of free rent to move if he signed a 2-year lease for 7 months free rent, because they are trying to get people to move and stay in the city. I was like, 7 months? That was crazy.
That is wild. It's kind of an Amazon angle where they hit you with low prices at first and then raise them over time.
Sign a 2-year lease. I would sign a 2-year lease if I get 7 months of free rent.
Sure.
Where were those deals when I was young? That's my question.
All right, well, that concludes the questions that we have. I'll give you both an opportunity for any final thoughts before we close out. Danushka?
I would say, last year was crazy. It was a wild year. Nobody anticipated what would happen. And from NHB, we were doing forecasts every 2 weeks because the the data was changing so rapidly. But I think right now it has shown that, we as, how resilient humans are, and we have adapted really well compared to what a stressful year last year has been. And I think if everything goes well, this would be the rebound year that we are all hoping for and anticipating. And I'm hoping for a good year, economy-wise and personally as well.
Yeah, I think so at the national level. And, here in Nebraska, I think the pattern the last few decades has been relative stability. So the recessions aren't as severe here, and the post-recession bounce isn't as large. And I think we'll see that again here. So we'll definitely see a relative boom in economic activity, the second half of the year as more and more people get vaccinated. But I don't think we'll see quite the level of boom that you'll see in states like New York and California and others where the economy is impacted more. And I do think we're going to have a little bit of a struggle getting people back to work. Not that there's something wrong, but because that's always a challenge coming out of recession, and this unfortunately won't be an exception.
I was surprised earlier when you mentioned that of 80,000 jobs lost during March and April of 2020, we already have 60,000 back. I mean, that seems pretty promising since the pandemic is still ongoing. So I think that gives us good reason to be hopeful.
Oh, absolutely. Yeah, we start from a better place. So even if our recovery is a little slower, I think we'll be relatively well off. That's the usual pattern in the period of a national recession and the years following it. Nebraska looks relatively good, and then we fall a little bit behind as the expansion takes off, and then the pattern seems to repeat itself with each business cycle.
Well, thank you both so much. That concludes our presentation for the day. I'd like to thank everyone for attending, and again, our presenters. Also, again, thank you to our sponsor, Westgate Bank. This webinar has been approved for 1.5 hours of continuing legal education. If you'd like credit for attending but have not yet entered your license number, please contact us at outreach@nifa.org. Remember, this webinar, along with all previous webinars, is recorded and available at nifa.org under Community Development Training, and webinars are on our YouTube channel at NIFA Housing. One last plug for www.housing.ne.gov, a free website for listing and finding rental properties. We have a special webinar tomorrow, and then we'll be back to business as usual next week with our highlighting housing authorities. And so we will see you all then. Thank you so much.